I want to run through the top mistakes I saw my S-Corp employee owners make in 2025. We're sitting here, clients for 2025, and here are the 5 things that I have seen my clients miss. Number 1, the accountable plan. The S-Corp has a very efficient tax strategy, and because of that, the IRS makes us jump through some hoops. One of the things that we need to do differently in an S-Corp is reimburse ourselves for things that we pay for from a personal standpoint that has a business benefit. So what this means is business use of home office, or business use of personal vehicle, business use of personal cell phone, anything that you went to Amazon and you accidentally put it on your personal card, but really it was for the business. The IRS says for us to claim these things as deductions, we need to reimburse ourselves as employees. And this is all subject to our accountable plan. Now, this is a dot your I's, cross your T's kind of plan. And it pretty much says that my company is adopting this plan that will reimburse employees at least every 90 days for expenses that they incur on a personal level. This is not something a lot of people do, truth be told, and there are some workarounds, but what we really want to be sure of is that we are capturing these things before the end of the year. A lot of us are cash basis taxpayers, and so if our company's on a cash basis, then when that year closes, the deductions are lost. So that's the number 1 thing that made me sad for some of my clients this year. The next thing, kind of following in that same trend, is vehicles. We get all excited about depreciation and, oh, we're going to write off, our vehicle this year and we're going to have these big deductions. And that can be true. There are 2 ways that you can manage vehicles for your company. You can either buy it personally and have the company reimburse you subject to your accountable plan, or you can have the company buy it. But here's the thing that gets missed. If you are personally using your company's vehicle and you are an employee of that company, you now have a taxable fringe benefit that needs to be included on your W-2. This is called the personal use of the company car. This is another one that gets missed a lot. So when I advise my clients about company vehicles, it doesn't really matter if the company's paying for the vehicle. It doesn't really matter if the company, has title of the vehicle. What matters is the usage. If you have a lot of business miles, then having the company buy the car absolutely makes sense, but it's still going to come down to usage. And so this is where everybody should be keeping their mileage log, document what they're driving, what category it goes into, business versus personal. If it is personal, make sure that the company is reimbursing you regularly for that. But if it is going to be a company vehicle and there is a little bit of personal use, make sure you're picking it up on your W-2. W-2s, not paying yourself enough. Few things here. As an S-Corp, the IRS requires you to take reasonable compensation. And if you're curious about what reasonable compensation is, or the ins and outs of owner compensation under an S-Corp, I have a course that kind of goes into these things. It's a 50-minute course. It comes with some resources, calculators, and things like that. So I will put a link in the show description notes, and you can check it out there. But one thing is not paying yourself enough. If you are found to be underpaying yourself, the IRS has the prerogative to come in and recharacterize what otherwise would be your tax-free return of capital or shareholder distributions. They could say, hey, you took $150,000 in distributions, you paid yourself $5,000. Really, we think reasonable compensation is $80,000. And now we're going to assess you for payroll taxes, late payments, interest, all the things. And even worse, a lot of times these things are found several years down the road. And so now you're on a statute and these adjustments aren't even tax deductible. So it's a lose-lose. Another thing I want to say about the W-2 is if you are an employee owner and you are getting health benefits from your company, as a 2% shareholder, you are required to pick up the value of those health insurance benefits in your W-2. This then becomes tax deductible on your personal return, but if it is not included in your W-2, it's not really deductible. 401k. So these two, W-2, 401k, these go hand in hand. Retirement benefits for self-employed people tend to be way better than employees because you get an annual max that's upwards of 70, it changes every year. So to maximize this though, in an S-Corp, you have to have a higher W-2. You could do a self-employed pension. I like to encourage my clients to get a 401k because I think you can get to the annual limits for self-employed people faster. You get your traditional employee portion that has to be funded in the calendar year, and then you have the employer portion, which is going to be 25% of your W-2 compensation. So if you were taking a $5,000 W-2, that retirement contribution from the employer side is not going to be very, very big. And what I love to say about the employer portion is that this is your Hail Mary. The year has closed, you've got your income, you've got your deductions. There's not a whole lot left you can do to minimize the tax. However, this contribution can be done up until the extended due date of the tax return, 9/15, to fund. So in a lot of instances, if you still need the deduction, this is one of the few ones that you can take. All right, the last thing that I saw my clients miss is state specific. This is called the pass-through tax election, and this is something that high income tax states like California, which is where I am, came up with in response to the tax law changes that were implemented by Trump, and circumvent the state and local income tax cap on the personal return. Words. So the pass-through tax election is where the state will allow you to pay I'll speak for California, pay a fixed percentage of your net income and deduct it as a tax payment on the federal return. So what it does is you report this payment for state taxes, it becomes tax deductible. Then on your personal return, you then claim that tax payment as just as if you had made a personal tax payment, very much like an estimated tax payment or a tax credit. But I know for California, they were very rigid about the participation, and that if you wanted to participate in this program, you had to make a payment by a certain date. If you didn't, you weren't eligible to participate in the program for the entire year. I know I had clients that missed it by a day, and when I called the state to ask if they could still participate, they said no, hard no. So that is just a real bummer of a lost deduction. So you really want to make sure you know what your state's rules are around participating in those programs. Set your reminders, make sure you're paying the right amount for the right year so that you're not losing that deduction. All right, I hope this was helpful. If there are other topics you'd like me to cover or want me to talk about any of these more, just put some notes in the comment section and I'll see if I can't create something for you.